Good morning. It is already almost mid-March, and we are marching through the year. We actually seemed like a horrible week last week, maybe because the previous week was so bad, but actually we didn't see much change in prices on grains. May corn down 1 cent, as was May soybeans. May Chicago wheat and Minneapolis down 5 cents for the week. Not really a major change in the markets, but it was such a horrible week before. Our first few days we went down, kind of stabilized and rallied later in the week, leaving us with very little change. But look at these outside markets. April crude oil down 270. That's almost 4%. Huge declines in energy prices. We are at the lows of the year. April gold, though, reversing some of last week's losses, gaining $66. Actually, I liquidated my long gold contract. I think that gold maybe has some trouble. And look at this. The dollar down 3.746 points. Huge decline in the dollar. And actually, that might be the most bullish things for commodities long term because that dollar was just killing us the last few months. Let's look at these charts because I've got a lot to talk about this week. Look at this corn chart, just a straight knife downward. The first 2 days of this week did the same, but we recovered and ended up unchanged for the week. But the week before was absolutely devastating to this market in this chart. We certainly broke that uptrend, and now this is our first recovery. Actually, I'm looking at this recovery in the corn market as a place to sell and make some additional 24 sales. And I'll explain why in a minute. I'm actually going to show the for some of the corn the nearby month. So you see where cash prices were so far this past year. We made our low in cash prices in August, and cash prices have gone up into our high of 520. That's well above our high of the past year on that nearby chart. We actually are recovering back to the old high on the nearby chart. I think this is a great place to make additional corn sales because I think the cash corn market is in some trouble. We've got this tariff threats coming up, but look at where we are on the cash corn chart. We're actually in the top half of that historic range. So we have been making some aggressive sales of corn. This is the May corn contract. We basically went to new highs and looks like we're only in the middle of that range. But if you look at cash prices, actually we're getting to the point where cash corn sales are getting more favorable. I still would just hedge the futures. Quite honestly, I think we should hedge another 25% of 2024 corn. Of course, we're all at risk. There's no crop insurance or price protection that we've got in place for that. I think we need to get more aggressive in our corn sales. Let's just review where we've been in corn. We made some pre-harvest sales averaging around 492 on 24 crop. We bought that back at 402, not the bottom, but not bad, taking 90 cents on those early sales. Sold 15% at 446. Actually, that was a decent recovery at the time. Sold 20% at 507, just maybe a dime below the highs of the year so far. Sold 20% at 515, just 2-3 cents below those highs. Actually, so we're sitting at about 55% sold. That's not enough. The way I look at these charts, I think we want to make another 25% sale Sunday night and Monday, getting ourselves to 80% price 24. Maybe we will wish we were 100%. Frankly, we need to get something sold because corn is the only commodity that has decent sales. If you're raising wheat and soybeans, I don't expect to make any sales in wheat and soybeans for at least 6 months. Unless we can get this tariff situation resolved more quickly, I think farmers have a great deal to gain from this, but I think this tariff situation is going to last a while. And that is most negative wheat and soybeans, but I think that's exactly why prices are so low. In 25 corn, we sold 15% at 466 December. In January, had a 35% sale that day. Sold another 20% at 472 Dece on the way down. So we've got 35% of 25 sold, but almost nothing in wheat and soybeans, and for good reason. You look at these soybean charts, we're sitting basically on the May contract near the lows for the year. We had this spike low. There's really nothing interesting to sell here, but I actually note that soybeans look like they're stabilizing. And actually, I think the soybean and wheat charts are gonna do better. I think those crops are gonna do well this coming year. I think we're gonna switch 5 million acres of corn, of soybeans and wheat to corn, and I think that's gonna improve the soybean and wheat chart. This is the nearby May contract. This is the cash soybeans. Notice cash soybeans bottoming. I don't think we want to make any sales. We're basically looking at $11 to $12 targets here in soybeans to make those sales. And I don't think we're going to get there maybe for another 6 months or more. The weather in South America is becoming less important. There is some rain moving into Argentina. Basically, it's mid-September, like mid-September there by the time you get a week out. In 2 weeks, I mean, basically that's harvest. You don't want rain at harvest. Temperatures are still warm, but the week 2 is going to cool. Not really. Actually, South America is becoming almost unimportant. Other than if they get too much rain at harvest, it actually reduces crop potential. This is the Chicago May wheat contract making new recent lows. There's nothing to protect in the wheat market. Nothing. No reason to make cash wheat sales. And if you look at the nearby contract, is showing cash prices actually stabilizing. We're still in the bottom 25% of the range. Really, the Minneapolis May contract looks the same, and the Minneapolis cash price, which is like nearby futures, looking stable, looking a floor here. But because we've got these tariff threats, I don't think we'll see any opportunities to sell at a decent price. And, you know, when we're talking spring wheat, decent to me is $7 to $8 prices. So, you know, in this range, and we're just not, we're not anywhere close to that. And I don't think we will get there in the near term. So we're starting to get to the point where U.S. weather is important, but this 8 to 14 day outlook, below normal rainfall here in winter wheat belt, that's not good. But man, temperatures are not, the warm temperatures are moving out, cold temperatures to the west. I don't see anything significant in the weather indicating, you know, bullish or bearish at this point. You look at the crude oil contract, we're up basically at our highs to start the year in January. And look, we're basically almost at the lows. And if you look at the nearby contract, we are at new recent lows. Actually, that says to me, it's probably a good time to buy some energy needs. Buy 25, even up to 50% your energy needs, as long as you have a good basis locally. I think it's a good time to actually buy cash energy. We're at the lows of the year, basically. The gold market, I mentioned it, liquidated any long positions. We had a spec long, took like a $20 or $30 profit, but I don't like this. You broke the uptrend, and I think that gold looks like it could be soft, and maybe some of these tariff wars are softening that market a bit. But look at this. This is probably the most bullish development. U.S. dollar, precipitous decline these past 5 days. Holy cow. We've almost lost all of the gain from October into January. That is a bullish sign for commodities long term. If we can get these tariff situations solved, and there's no question that the United States is in a very strong position. 25% tariffs on China. We import 360 billion more than they import from us. Man, it's gonna cost them, you know, $90 billion. And to spend $5 billion on ag, the only thing they seem to want to buy from us, I think if we solve these tariff problems, it's going to be very bullish grains. Mexico, we import 160 billion more than they buy from us. 25% tariffs is $40 billion. You could sell the entire U.S. wheat crop for maybe $8 or $9 billion. So Mexico has a tremendous incentive to settle and actually buy more from the U.S. What do you think they're going to buy? They buy a lot of corn. Actually, one of our big markets because of transportation costs. And Canada, we We import 40 billion more from Canada. The 25% tariff is $10 billion. They can buy a good share of our crops as well. But Canada doesn't import from us; they export to us. Actually, to help agriculture, the best thing we could do is keep tariffs on Canada, because durum prices, canola prices, actually beef and pork prices will all go up if we keep tariffs on with Canada, which is an interesting situation. But we lose on the energy side. So, I mean, trade is good, but it has to be equal and balanced trade. And I think that's basically what we're looking for. When we solve these trade situations, it is going to be very bullish agriculture. The reason I think that these tariffs will last is because you listen to what the administration is saying. They're basically saying, man, farmers, get ready. We're going to have to be prepared to fight this tariff war. Long term, it's a gain, but short term, you're going to have some pain. And already the administration, our Ag Secretary Rollins is talking about, compensating farmers for the losses due to these tariff wars while the war is being fought, for positioning and jockeying. U.S. is in a very strong position, being a big net importer from China, Mexico, and Canada. But there's going to be some pain, and agriculture is going to feel it. Secretary Rollins already said, yep, we're probably going to have to throw money at farmers to compensate them for their losses while we're fighting these tariff wars. And actually, our former governor of North Dakota, Interior Secretary Burgum, has said the same thing. I think the administration, and I think Trump tweeted that farmers are going to have to get ready to compete in that. I think he's warning us these are going to last. This is a short-term fight, 6 months or more, maybe even a year, to have long-term gains. And I think that's a warning worth heeding. So we need to play defense, especially in the next 6 months, big time defense. That's where some of those corn sales come in. I want to talk about revenue crop prices too. 470 established for corn. That's basically right at or near break even, according to USDA, for the national average. 473 is break even. None of these other things look close to break even. 1054 soybeans might be $1 below break even. Spring wheat, 655, probably $1 below break even too. I think we're going to attract acres to corn. USDA said 3.4 million would shift into corn from wheat and soybeans this year. I think in the end, these revenue prices are going to enhance that. We probably will have 5 million or more acres shifting to corn from wheat and soybeans. And that's going to make wheat and soybeans more bullish, especially when we get over this tariff situation. Wheat, soybeans most affected. We export, anywhere from 40 to 50% of our wheat and soybeans each year to other countries. We only export about 1/7 of our corn. So I think that's a situation that's going to continue. Interestingly, these dry bean prices were higher this year than last, everything else lower, but certainly makes some profit opportunity. But the highlight of these crop insurance prices is 470 D's corn. That's the closest you're going to get to break even on any of these major crops. 4 cents higher than last year. We're going to attract acres to corn. I think more than 3.5 or 4 million will probably get 5. And it's going to come from soybeans and spring wheat. Look at that, $1.01 lower than last year's price. 1054, and spring wheat 655, 29 cents lower than last year. I want to look at this because you can get ECO coverage at a 40% lower premium, 95% revenue coverage. Our biggest risk is price. And look at this. That's 95% of 470 is 447 D's corn. We're trading 454 on Friday. We've already lost 4% of that 5% deductible. Man, these makes it attractive. 1001 soybeans is 95%. We're already at 1025. We've already lost 3% off this 1054. 622 September Minneapolis is 95% of 655. 617 is where we're at. We're already down 6%. That makes ECO very attractive. Best advice I can give you on managing your 2025 price risk, buy 95% ECO. That's like a 450 put in corn. They're selling currently at 33 cents because, of course, we're 4% below this price already. You're at basically at or near the 95% level. $10 soybean put is 45 cents today. Look at your Chicago Board of Trade futures quotes. 620 September Minneapolis put is 45 cents. That 620 is what you're getting, a 95% put option. Basically a 620 put you buy. Look at the comparison of Chicago Board of Trade valuation of those put values to the ECO price. Corn on 180 bushel, 33 cents a bushel for a 450 put. That's worth $59 an acre, 5 times what you would pay for the ECO 95 corn coverage in Cass County on 180 bushels. Actually, $12 to $15, maybe $10 to $15 is the cost of it, depending on your yield. But at 33 cents a bushel, the put options from the Chicago Board of Trade cost 5 times that. So because you got a 65%, government's paying a 65% subsidy, and already prices have dropped 4% in to make that more in the money from that original price. Soybeans at 40 bushel at 45 cents is $18 an acre. ECO is about 5. It's 4 times more money, almost 4 times more money for you to buy that on the Chicago Board of Trade. We need our coverage. We need risk management for 25, and this is the best way you're going to do it, is buy that 95% put. February price was 10.54. We're already down, 4% from that, 3%, and you get a 65% subsidy when you buy the put through ECO. Hardwood spring 70 bushel at 45 cents is $31 an acre. Actually, ECO 95 is about $5 an acre there. 6 times more expensive to buy put protection on the Minneapolis Grain Exchange than you can buy 95% ECO. No brainer. You need to buy that. Take that 65% subsidy on a put with a starting at 655. We're already at 620 or lower. Buy ECO 95. You're basically done marketing until we get a price above that February base price. In fact, I'd like to see a profit on those. You have that 95% put option. Do not lock in losses. The only thing you can do by marketing now is lock in losses. Take the put protection, let it ride out through this tariff threat when you're going to need that protection. Take the government money when they compensate you for it. You've got a farm safety net that's going to also pay you if prices are low this coming in 25 year. We've got the risk management we need. We just have to be smart and take it in the right place. Then we try to get break even or profit margin between now and harvest. I think we need 470 plus these corn. That's why we were selling corn above 470. $11 to $12 no soybeans. No opportunity to do that yet, or $7 to $8 set Minneapolis. It's a defensive year, and this ECO is going to do it. We also talked about harvesting that ECO, selling culls. We got to get above 470 corn to do that. Remind you that risk management scorecard. Here is our price protection with ECO. 655 spring wheat, 470 corn, 1054. 95% of that price is here, and basically we're almost right there. We've already got our risk management. We have our ARC county protection at these levels much higher than we were in 24. So we've already got some pretty good protection in place there. Risk management scorecard, getting the red out. You buy your 75% EU insurance or more, you have 25% left at risk. Add ARC county, FSA, farm safety net, sign up, you get 10% minimum. Take another 15% of the risk out. Add ECO, take another 9% risk out. You only have 6% left. Actually, if we get compensated for tariffs and we get an ECO payment this fall, if we have the right risk management plan in place, can hold the grain and sell it later once these tariffs are ended. If the US dollar continues down, we're going to have actually a pretty good profit this year, but I don't expect to sell much more in the next 6 months. That's another reason why I want to make some of those 24 corn sales Sunday night or Monday. So if we can get some calls put and become a minimum break even, we have 80% of the market upside, and we'll market well, but I think a lot of those opportunities might come later. We could get an opportunity, though, to price grain above this these targets yet. Sometime between now and harvest. And that opportunity comes, we have to be ready to sell. You know, if we get above $7 wheat, 470 Dees corn again, and $11 soybeans. And I do think there's at least a 50, 60, 70% chance of that happening sometime between now and harvest. We can get some other grain sold. And actually, we've got the protection in place. If you want to look at some of these harvesting ECO or that analysis and you want commentary, call this number or Joan at Progressive Ag. Those marketing recommendations throughout the year when we make them, like our corn sales we made, is a good thing to have in place. So essentially, we've got an opportunity to by next March 15th, actually March 17th this year, because the 15th on a Saturday, you will need to take advantage of some of these price protection tools we have through our crop insurance. ECO 95 is becoming a no-brainer because of where the market is and the protection and the situation we're in. Agriculture has been forewarned by our administration. We're going to be fighting a trade war for maybe months, maybe even up to 6 months or a year. Last time it took a lot longer. Maybe it will be shorter this time. The United States is in a strong position, but people are stubborn. You know, the other countries don't want to give up easily, and China didn't. And so we've been kind of forewarned. We probably are going to have a situation, at least for a while, with this trade war. I like that protection. I think if you've got 24 corn, it's the only thing we'll be able to sell maybe in the next 6 months. And so we want to get more aggressive on pricing that because that's the only thing we have a decent market for. And because of these insurance prices, we're going to attract corn acres. And I think that's going to improve the wheat soybean outlook. That dollar going straight down basically since mid-January actually is a bullish thing. Once we solve these trade wars, we could make some pretty significant money selling these 25 crops. But I don't think most of those opportunities will come in the next 6 months. We get some crop scare, maybe we'll get some opportunity, but we need to get through these trade wars, let that dollar continue to decline. We'll have some opportunity. So a lot to think about, but you do need to make some decisions by March 15th. I think that ECO 95 is going to work very well to protect our prices. Certainly, you know, 1/4 to 1/6 or 1/7 the cost of buying puts. So I think that becomes pretty easy to manage risk. Hope you have a great weekend and good marketing.